I'll start the recording. Also start sharing my screen and kind of dive in to the presentation section. First and foremost, I think it's important to understand what attorneys, regional centers, and in general, when people say source of funds or SOF as it's abbreviated, what does this actually mean? The key consideration is that we have to show to USCIS that the $800,000 is attributable to the investor and it's also attributable to a lawful source. Now, what does this mean in practice? So let's take an example. Let's say Nikin worked for Microsoft and Nikin has about $100,000 in savings. Now, how can I show that this $100,000 is lawfully obtained? The way it works is that the attorney would ask for 7 years, typically, of bank statements, tax records, and pay stubs. Why 7 years? It's because that's how far most banks go in terms of record keeping in the US. If they went longer, it would likely be longer. And also, that's kind of what USCIS has come to expect as well. That's become the standard in the space. So, $100,000 in savings. How do we prove that? The way we prove that is you upload all of the information, and the attorney literally takes a highlighter and they kind of go statement by statement and they say, hey, Mr. Officer, look, Nikin received a paycheck from Microsoft. The employer paid taxes on it. Nikin paid taxes on it. And a portion of this went to his savings. And again, this is for us who have a disciplined savings account and set it up that way. But in most of our cases, we have one bank account and the funds are commingled there, which is where this exercise becomes a bit tedious, a bit time consuming. But they do this step by step. And once they've shown $100,000 of funds have come from my Microsoft salary, they say that this $100,000 is source of funds cleared or SOF cleared. And then typically, even though it's from my earned income, we set up another bank account, like a new bank account. So these funds move to that staging account and then it's funded to the project. And this applies not just for salary, it applies for all other sources of funds as well. So we're talking about taking a HELOC, we're talking about taking gifts from friends and family. It kind of all has to be first cleared by the attorney. Then we initiate the transaction to that staging account. So the funds, 100, 400, 800, gather in that staging account, and then it's funded to the EB5 project. We're going to go about each of these in more detail in the next set of slides. But hopefully that gives you some context around the attorney's thought process when they're asking for documentation and you're taking the next steps, the source of funds process. Now, first and foremost, the most direct type of funds is, of course, earned income and savings. And as I just shared, what do we have to show in terms of documentation? We have to show tax records, bank statements, pay stubs going back several years. We also have to show employment verification letters. Now, what I'll also share are certain flags, as in what sets off an alarm bell or maybe some concern for the attorney. What they are mainly looking for are any large transactions, typically over $10,000, which are unaccounted for. And what do I mean by that? If there are transactions between you and friends and family, or you and any kind of business, for example, and there's no clear explanation for it, that's something that the attorney and USCIS get concerned about. Now, usually, this is caught at the attorney stage. So what the attorneys do will, as they go through your bank statements, they will flag these transactions and they will ask for an affidavit. So they'll be like, if I was an applicant, hey, Nitin, in 2020, we see these transactions. These are large transactions, outgoing, incoming transactions. Could you please explain the purpose of these transactions? And most of the time, innocent enough explanation, right? Is that, oh, this was for family remittance, this was for education purpose, healthcare purpose. I helped my dad pay for a property in India, what have you. So 99% of the time, that's that. Very simple to document. Where it gets perhaps a little tricky is sometimes we loan out money for our friends or we gift money to our friends and family, and maybe they pay us back from a different bank account. So, an example of this is, let's say I help my friend Dilip purchase a car. So I paid him $10,000 here in the US, and Dilip later on, a year later, he pays me back, but from a bank account in India. So there's a year of time difference. These are from different bank accounts. And of course, an attorney doing their part would catch this and ask for an explanation. But now that you are aware of this information, on the applicant side too, we can be more proactive. Go through our bank statements, maybe even use a bit of AI help and start flagging these transactions and adding explanations next to them and putting together a document to that effect. So it substantially makes the process much more efficient and moves things along quicker. There are some other edge cases too, but in the interest of time, just wanted to share one or two examples on the source of funds aspect and then move on to the next one. So the next very common source of fund, I would say, is a HELOC. And for those of you who are unaware, what is a HELOC? So let's say you've purchased a home in the US and the home was worth $1 million about 5-7 years ago when it was purchased. And now it's appreciated in value to close to $2 million. So basically, a lot of banks in the US and even the company with which you have the original mortgage, they allow you to borrow against that increase in value. And you may still have some mortgage payments remaining or some mortgage debt on that property. So you do have to subtract that. But for a lot of people who bought homes, especially pre-COVID, they've seen an almost doubling of value or meaningful appreciation of value. And they have a lot of equity stored in their home. So this becomes a very common mechanism on putting together a few $100,000 in funds for the $800,000 requirement. What are the key things to be aware of for HELOCs? So from a source of funds perspective, USCIS cares about how the property was purchased. So you have to go back in time and show with what funds the property was purchased, and also how you continued making payments on the property. And here too, sometimes we tend to use gifts from friends and family, or we borrow money from some sources to make the initial down payment or to make some interest payments. So those, if there are any inconsistencies, those do have to be explained. Now, coming more on the borrowing side, the main thing to be aware of are the rates. So we have something called the prime rate, which is, you could say, the standard rate in the market. And the most favorable HELOC terms that we have seen are it's close to the prime rate as possible. And we're talking about 5.5%, 6%. And you have a very high loan to value. So the amount that the lender is willing to give you is very high. Actually, in certain cases, we have seen even up to 95%, but those are edge cases and not the norm. And in terms of timeline, that's where people perhaps tend to delay the HELOC process. So you do want to have an appraisal done on your home, and only after the appraisal can the lender help with the HELOC process. So booking an appointment for the appraisal, going through the process, it generally takes around 30 to 45 days. And that's an important timing consideration. And finally, HELOCs are interest only. So if the interest payments are manageable, this becomes a highly favorable tool for us to consider. Now, what are the lenders that give you the best terms? I mean, we have helped applicants do a search for HELOC lenders multiple times. So, in terms of lenders that always come out on top are credit unions. So, there are different types of credit unions. You, of course, have credit unions that are in your county. So, those are the ones I would recommend taking a look at first. Then you have state level and federal level credit unions. And finally, you have membership based credit unions. So certain unions have it, alumni networks of universities have their own credit unions. So overall, the credit unions tend to give the best rates, the highest loan to value. But the trade off is that they're very hard to get a hold of. So many of them still operate pen and paper. You have to call, book an appointment, go in person. So they might not be very digitally savvy or be able to adhere to a very strict turnaround time and processing timeline. And on the other hand, there is a difference between taking a HELOC on your primary property and investment property. So it's a primary property, if it's still owner occupied, then you have a lot more lenders available. And the number of lenders for an investment property dramatically reduces. So just to summarize, HELOCs, very common source of fund. The documentation side, we kind of have to go back in time, show how the property was purchased, how we made the ongoing interest payments. On the lending side, I'd recommend checking out credit unions first, local state credit unions. Their processing times might take a little longer. They often come out on top in terms of terms. And then also we have to be cognizant of whether we are taking the HELOC out for a primary property or an investment property. Moving on, related to HELOC, but a slightly different concept, is a cash out refinance. And where does this apply? This typically applies in cases where you're paid off the home. So you own the title to your home. So here the documentation requirement is the same. Still have to show how it was purchased, how you made the interest payments leading up to paying off the mortgage. However, on the lending side, you do have a bit more flexibility, as in we have seen cases where, the average time for a cash out refinance, it does take a month and a half. But because you own the title and it's clearly in your name, we have seen the turnaround time much quicker on this aspect. So the process is very similar to a HELOC. The main difference being it's a different term and workflow if you own the house outright. So it's called a cash out refinance. Moving on, 401ks. These are a very popular source of fund aspect too. But there's a distinction between a current employer's 401k and a former employer's 401k. Now, what is the main difference? With a current employer's 401k, if the employer is actively making contributions to it, we have very limited flexibility. So the maximum that we are able to do is take out a loan of up to $50,000. This is an interest-only loan. The interest can be paid directly via your payroll, and it goes to your 401k account. So you're essentially borrowing against yourself, and both the primary applicant and dependent can take up to $50,000. So you can take up to $100,000 in case that situation applies to you. And also, when we go down this route, the funds come directly to your account. You often get a check, and then we have to put it in the staging account and, of course, into the EB5 project. The difference with a former employer's 401k, and just to be very clear, so this is a 401k account in which an employer isn't actively contributing, is that we can use every dollar in funds present there. And why and how is this possible? So the process involved is called a self-directed IRA. So we do a rollover. So the funds go from your prior employer's 401k account to a self-directed IRA. Although we don't have any affiliation with it, it's a very common provider that's used for this purpose. And once it's in the Alto account, you can do what's called a trustee to trustee transfer. And the initial trustee might be the S&P 500, for example. So a sale happens out of that position, and then the funds go to the EB5 project. And this is important. When the project matures, the funds come back to your self-directed IRA or SIDRA account. So basically, the funds never left the retirement system. And as a result of that, you don't owe any taxes on this. And there are no penalties as well, since they were completely within the retirement system. Now, a good question to ask here is, hey, Niken, you told us that in the first slide that the funds kind of need to be attributable to you. They have to be in your personal account or first come to that staging account and then go to the project. So how is a rollover that you're sharing here compatible with overall USCI's guidelines? And that's something attorneys have now gotten a lot of experience with and arrived to a consensus on. The reason this works is because you're still in charge of directing your funds. And that's an important aspect on the compliance side. And also, there's no doubt whose funds this is, right? So the employer has been making contributions into your retirement account for the past several years. There's no commingling and such. This account was specifically set up for your retirement benefit, even though that is more longer term. So overall, in terms of 401k, just to summarize, there's a difference between what we can do with a current employer's 401k versus a former employer's 401k. The current employer's 401k, the maximum we can take out is a $50,000 loan. With a former employer's 401k, we can actually use every dollar in funds there. And the final point to remember is the former employer's 401k, it only applies to the primary applicant. So that is one limitation of doing this. So if there's a husband and wife, and this applies to both of them, we kind of have to make a decision on who has the larger amount and who's going to be the primary applicant and go forward with that strategy. So moving on to another source of fund would be loans against stock. And overall, what we have seen with applicants is, especially in tech, applicants have a lot of vested stock in the retrade or brokerage account. But sometimes applicants have liquidated that, they've established another brokerage account, or even within that same brokerage account, they have a lot of other stocks too, S&P 500, trading stocks, what have you. So in terms of loans against stock, both of these can be borrowed on. So if you're doing trading or even general investment, that can definitely be used as a source of fund. And we can also tap into vested stock. And you might maybe have considered selling your stock. What we generally recommend applicants is that let's first explore, check if we can borrow against the stock. The main reason being, over the next few years, we can still benefit from the appreciation, the underlying value of the stock. That being said, what each applicant has to decide on their own is the following trade off, which is that when I sell the stock, I have peace of mind. I'm not thinking about being margin called, for example, but I do still have to pay capital gains taxes on it. Now, how does that compare towards me making the interest payments if I borrowed against the stock? So we kind of have to perhaps get our notebook and pens out or do some math on Excel and come to that calculation. So it really depends on a case by case basis. Now, speaking a bit more on taking a loan against stock, this is done in two ways. One is very similar to a HELOC. We can set up what's called a security based line of credit. So it's called an SB lock. The other way is we can take a margin loan against the stock. Now, in terms of the security based line of credit, most large brokerage houses offer it. So if you go to Charles Schwab, Fidelity, E-Trade, Interactive Brokers, they offer SB locks. Margin loan, that is, they offer it too, but to a limited extent. We find the people who have taken margin loans most commonly use Robinhood. Now, on the borrowing side, what are the key things to consider? Of course, we have the interest rate, but we also have the loan to value. And what we have seen here is if the portfolio is diversified, we have a higher loan to value. So we've seen 80%, 90% in diversified portfolios. And if the stock is concentrated, that sometimes drops to even 50%. But of course, this depends on which stock we're talking about, which brokerage we're interacting with. So it's on a case by case basis. The other is also staging time. So we're moving very quickly. Most brokerages, let's say if you're setting up a new account and you're transferring your portfolio from another brokerage, they have basically a cooling off period. So it could be a week, but in certain cases, I think with interactive brokers, it's even a month. So you have to keep the funds there for a month before you're allowed to draw against it. So it's key to have that conversation with the client relationship manager ahead of time. So especially on the timing side, there's clarity. Now, how do you approach this in terms of finding the best rates and just navigating loans against stock? So what we have seen very often is E-Trade sets up offers for applicants. So even if you're an existing client, you can go to them and then you can be like, hey, I'm willing to move the rest of my portfolio here. Wink, wink. Your portfolio could already be there, but it could be like, I have more of a portfolio in some other places. And I've seen E-Trade very regularly set up a plan where you're in a variable rate, or maybe like 8% for 3 months or so, and then it drops to 5.5% for a year or more. And if you have a plan to pay off this loan, then with using other funds, then this could potentially work out for you. So E-Trade, they have set up these custom offers for a lot of applicants. Recommend reaching out to them. But overall, in terms of the lowest rate, so we are going for a SB lock, it would be interactive brokers. So the highest tier, we have consistently seen them offer 5.5%. We're taking a margin loan that Robinhood comes out on top. And again, at the highest tier, we have seen them offer 4.7%. So just to summarize, loans against stock, very common source of funds. We can shop around for the best rates and terms in terms of the loan to value as well as the interest rate itself. If the portfolio is diversified, more likely to get better terms than if the portfolio is concentrated. And the two main ways of doing this is an SB lock and a margin loan. Moving on to another source of fund that we get a lot of questions about are personal loans. And here I'm talking about unsecured personal loans. So in terms of personal loans themselves, I mean, the consensus among attorneys and the space in general has definitely changed over the past year or so. And initially, it was very favorably looked on, which is as long as the full 800,000 is attributable to you, I mean, you could mix and match different sources of funds, even a large amount could be an unsecured personal loan. That's perfectly fine. But now that's kind of changed. So the most conservative attorneys, they're like, let's not even go anywhere near an unsecured personal loan. Whereas other attorneys say, hey, let's have a maximum amount, or maybe $150,000 or $200,000. Now, why do they suggest this, or why has the thought process changed? It's because of what USCIS is jumping to in terms of conclusions. So just to unpack this, the key part of taking an unsecured personal loan is your repayment ability. So your net worth, assets, credit score, who's your employer, how much income you're making, and just your fundamental ability to repay that loan. And if the loan amount is higher, I'm talking about 150, 200,000 or more than that, the conclusion that USCIS unfortunately jumps to is that, hey, we're looking at all of your other documents and it's not clear to us that you have this repayment ability. So why are these lenders lending you this money? Is it because maybe you're using the project as collateral? And this is a stretch. This is a leap in terms of what they are doing. However, it's USCIS being USCIS, right? And we just have to be proactive on our side. That being said, if we were taking out an unsecured personal loan, let's say for $50,000 or a similar amount, what should we watch out for? The main thing we have to watch out for is in the loan sanction letter. We have to make sure in the restricted activities or prohibited activities section, there's no prohibition on using the funds for investment purposes. Because lenders like SoFi, they advertise a lot, they give great terms and rates too, but unfortunately, they have prohibitions in that section. So as a lender, SoFi and many of these fast online lenders are not good sources for financing when it comes to EB5. But you can check out First Tech Credit Union. It's one of the common online lenders we see, which is compliant. And I'm sure that there are other lenders as well. And happy to share more details on this later. Moving on, there is another source of fund pathway that people explore, either as a primary path or even as a backup, which is transferring funds from India to the US. They may have some personal funds, they may have gifts from friends and family. They're in the process of transferring that. What are the main considerations here. Number one, if you're doing it through your NRO account, so let's say through ICICI Bank, Access Bank, you have an NRO account set up. If the funds go first to your NRO account and you transfer it to the US, you're allowed to transfer up to $1 million a year. You do have to let the bank know. You still have to fill out a few forms. I believe it's 15A, 15C, those are the name of the forms. But you're allowed to transfer up to $1 million a year without any tax liability. Now, this is very different for people who are resident in India and who also live in India, in which case the limit is $250,000 a year. And if it's blood relatives, I mean your parents, husband and wife for that matter, then the limit is $500,000 per year. Now, there is another very, I'd say, overlooked or people don't explore this mechanism in a lot of detail until like push comes to shove, which is property over the age of 20 years. Now, what do I mean by that? And let me just unpack that a bit. Let's say in the US, we are able to gather 400,000, 500,000 in funds, and there's a gap of a few $100,000, and we have property in India. And let's say it's our parents' property. So typically, USCIS, if something has been clear throughout this presentation, and if any of you have spoken to attorneys, is they are a stickler for documentation, right? So again, you have to show years and years of bank statements, records of how the property was purchased, how you made payments of the property, but with one exception. That exception applies to properties over 20 years old. So any property which is over 20 years old, all of this documentation requirement goes away. So the only thing we need is the purchase deed converted to English. And the thought process that is, again, we don't want to maybe sell the property. We can explore taking a loan against the property. And maybe it is my next slide. Yes, we can consider taking a loan against the property. And here too, there are a few banks which are very favorable. So you can go to IDBI Bank, IDFC Bank. In the sanction letter, they don't have prohibited language on using the funds for investments or taking the funds out of the country. And the third piece of documentation we need is a gift deed. So the funds are being gifted by our parents in this example to us. So then it's transferred to the NRO account. The funds come to the staging account here in the US. And just to summarize, again, this path, you want to perhaps keep it as a backup option. But the reason it's compliant is because from a USCIS perspective, the documentation requirement is substantially low for properties in India older than 20 years. We can take a loan against the property. We can go to banks, which allow us to use the funds for investment purposes, take it out of the country, and then we can be gifted those funds as well. There's no TDS when transferring it to the US, right? So this is a path we have helped a lot of applicants explore. People, I've gotten feedback from that people have explored this for gold as well. That's something that I'm less familiar with personally. So I'll just avoid commenting on it for now, right? So happy to answer any questions on this. So please feel free to share in the chat. Now, coming to gifts overall, any of the functions above, whether it's a HELOC, whether it's a loan against stock, whether it's loan against property in India, whether it's savings, any of these funds can be gifted to an EB5 applicant. However, whenever someone is gifting you the funds, the key thing to understand is that the giftor becomes a mini EB5 applicant themselves. So they also have to show 7 years of bank statements, tax records, their history, and whatnot. And if there are any transactions which are flagged, sign an affidavit explaining those transactions. That being said, the main reason I put the slide up and I wanted to cover this is on the taxation side. So the US has a lifetime gift exemption tax of $10 million. So let's say you were gifted 300,000 or 600 or the entire EB5 amount. All of that would still fall under the gift exemption aspect. So neither the person gifting you the funds or you, the receiver, would have any tax liability. All you have to do is execute a deed to the effect and share it with your CA so they update your annual filing when you file it. Finally, in terms of unsecured personal loans, another very popular loan option has been from regional centers. And over the past 2 years, this was a very common method of funding an EB5 investment. So regional centers set up sister entities, independent entities, and gave up to $400,000 in financing. But for all intents and purposes, that path is effectively shut down now. So starting in October, USCIS started issuing RFEs and denials for anyone with a regional center loan. And one might ask, I mean, if it was this risky, why did they even set it up to begin with? The one word that I would say people in the EB5 space are allergic to is being called an innovator, right? There's a very, very traditional, conservative, risk averse space. And the reason I'm sharing this is when these programs were set up, they were set up with people doing the right things, which is checking with and working with former USCIS officers, visa section chiefs, following best practices, working with the best in class law firms. And USCIS did approve 70 plus, maybe even 100 petitions. So a few hundred people have benefited from this. Then suddenly in October last year, they completely changed their thought process. And unfortunately, this is where immigration law, as any attorney would tell you, becomes similar to reading tea leaves. As in, there's a consensus in the space, start filing petitions, then USCIS changes their stance. The only way you would know is based on the responses, because there's no one to call at USCIS and say, hey, please tell us how you're interpreting the petitions. And no one from USCIS shows up at any of the conferences either. So that's kind of the nature of the space. Just want to share an update on regional center loans too, in case that's an option that you've heard of and were considering. I'll take a pause here. I'll also put my scheduling link in the chat. So in case you'd like to set up some one-on-one time to go over any of these in more detail or just to discuss EB5, happy to be a resource. So stop sharing my screen. I saw that there's quite a few questions in the chat, and